Now we're going to finish chapter 23 with the investment center. Now this one is probably the most complicated one because it has much more difficult equations. And not only do I look at revenue, cost, and income, but I also look at assets invested in the center. And we're going to talk about that in a little bit. So in here, there's two important things we're going to look at. We're going to look at what we call a rate of return on investment. So just to reiterate, assets invested in the center. So assets are things that you buy, major equipment, building, machinery, that type of stuff. So we're going to look at what is the rate of return on the investment. The asset that I buy, I'm buying for the sole purpose of making more money or getting a return on my investment. So I want to look at the rate of return, and I want to look at what we call residual income. These are the two components here. So here is my, I'm looking at data link, and I have three different divisions, Northern, Central, and Southern. Here's my little income statement, divisional income statement. I have my revenue minus my operating expenses equals my income before service department charges. And then here's my minus my service department charges. Here's my income from operations. So the first thing we're going to look at is called return on investment, or ROI. And here's the formula. You want to write this down. The ROI is equal to the income from operations divided by the invested assets. So write this equation down. This is going to have some equations in here on this one. The reason that we have to look at everything, we just can't look at revenue and expenses. We also have to look at the invested assets. These are the assets, again, that I purchased, the equipment, the machinery, the building that I actually purchased to help grow my business. So obviously the higher rate of the return, which is going to be a percent, it's the higher rate of return, it's going to help me generate more income. And so I'm looking to find what rate of return we're talking about. So right now, here are my invested assets for my three different divisions. And when I apply this to the formula that I told you to write down, my ROI, or rate of return on investment, for each division. So this one was the income from operations, which I got off the divisional income, divided by the invested assets, which gives me a 20% return. Central is giving a 12% return, and Southern is getting a 15% return. So this is really important because right now you know that the Northern Division is giving you the highest return on your investment, and Central is giving you the lowest. So this is important because often a company will establish what their required rate of return, such as maybe 10%. If this company said, look, 10% is my required rate of return, I'm not going to do anything unless it generates me 10% or higher. Well, all three of these divisions are actually doing stuff for that. But I need to talk about return on investments and taking it one more step. These are called ratios that we're looking at for the most part. And there's another ROI ratio, but this is called the DuPont formula of ROI. It's a little bit different because it looks at two different factors. It looks at what we call profit margin and investment turnover. So it's very, very similar to the other one, but takes it a little bit further deeper into it. So I'm going to show you the DuPont formula for the ROI. So here's the formula. Rate of return is profit margin times investment turnover. So just so you know, profit margin, here's the ratio for profit margin. Income from operations divided by sales. My investment turnover is sales divided by investment assets. So it's a little bit different. It looks at profit margin, investment turnover. So it's going to be a little bit more complicated. The whole thing about ratios is the relationship. And so what I'm actually doing here is I'm looking at the relationship, the underlying operating relationship of each division. Profit margin, that's how much money I'm actually making after my basic expenses. If you remember, gross profit. The investment turnover is how efficiently am I generating dollars or sales for every dollar I invest in my activity? So if I buy a $100,000 piece of equipment, that's going to generate me $300,000 more of revenue, then I could be very efficient as compared to me buying a $100,000 piece of equipment where it only generates me $150,000 of revenue. So the higher my investment turnover is, the better I am. So here's the formulas. I'm going to take the formulas and plug in the numbers now. So here's each division. Here's my formula right up here. And so I'm taking this information here. So if you notice, what they've done is they've actually taken this formula, and which is 12.5%, and this formula, which is 1.6. Okay, and then I'm going to multiply them together, and I'm going to get 20%. Now, if you remember correctly, when we did the other one, the Northern Division already had a 20% ROI. But this looks a little bit deeper because it's going to look at the profit margin here, and this is called, and over here is the, oh, excuse me, I had a brain failure, hold on. The investment turnover. So this side is the investment turnover, how well I'm turning. Obviously, look, the investment turnover here is 0.96, so I'm not doing that well here on the investment turnover, where I'm doing great here. But again, these are the same numbers we already had. So now, since I have this information and I know what my percent is, I can take this, and if I need to make, if any changes are going to be made to any of these things here, it could actually help me figure out what my new ROI is going to be. So for example, let's say that we can actually increase our revenues by $56,000, but I have to advertise more. So I've got to put more money into advertising, but it will increase my revenue. And so what I really am going to want to know is what percent of ROI am I going to be increased to? So here's what's going to happen here is if we go back and take a look, I'm going to go back a little bit, guys, okay? Here was, well, let's go back. I need to go to this one right here. So this income from operations, we're going to look at Northern Division, is 70,000 right now. So let's go back forward. Sorry about this, guys. I want to show you exactly what I'm talking about. Okay, so if my revenues increase by $56,000, so this is what they were before plus the 56, I now have operating expenses at 385. Minus that is income from operations. Here's my service department. So now I have income from operations of 77,000. So now redoing the formula, I'm now at 22%. So this helps me understand how I can take what I already know and project, should I increase this or should I decrease that, and what percent of ROI am I going to get? So what am I going to do with all this information with these three divisions? Obviously, Northern Division is earning the highest rate of return. So I actually want to focus there if I can, or expand any opportunities in that area because it's giving me the best return on my investment. Now, let me talk about one disadvantage about this program. The biggest disadvantage is that I might reject a new investment for my division because it doesn't meet my certain return on investments, but overall it could be better for the whole company. But if I'm doing it at the division level, I'll say no, it's not a good fit for mine, but overall it could be for the whole company. Well, let me show you an example. So remember, our Northern Division was doing a 20%. Now, remember I said each company would want a certain rate of return. So the minimal acceptable rate of return is 10%. So I won't accept anything less than a 10% return. However, a new project I'm looking at has a 14% ROI. Well, I might say, you know what? No, I'm already doing 20%. If I take this project on for my division, it's going to lower my 20%. But it could actually increase overall. If you remember, if I believe correctly, that the central division was only doing 12%. So it could actually help for the whole company, but the northern division will say, no, we don't want it. So that's why that information is important. So this concludes this part of the ROI for profit centers on chapter 23. And next we're going to talk on the next video, I'm going to talk about residual income.